1031 exchange allows an owner of investment property to defer 3 capital gains taxes upon the sale of the investment property: federal capital gains taxes, state capital gains taxes, and depreciation recapture tax. Those 3 taxes, federal, can vary very much depending on where the federal administration is at. Currently, we're at a 15% capital gains tax rate. However, we could see 20, 25, 35% over the next couple of years. State capital gains taxes can also vary. In certain state tax jurisdictions like California, we have high state taxes, such as 9% taxes. In other states, such as Florida or Texas, we have a 0 capital gains tax. The main tax most people forget about with 1031 exchange that you're deferring is depreciation recapture tax. Depreciation recapture tax is a 25% tax on all the accumulated depreciation that you've taken over the years while you've held your property. In the tax world, there's a saying that while you hold property, depreciation is your friend. However, when you dispose of the property or sell the property, depreciation is your enemy, because those accumulated depreciation deductions that you've taken are all assembled back together and recaptured at a 25% rate. So if you've taken $100,000 worth of depreciation deductions over the last 20 years, be prepared to pay 25% taxes on that $100,000. All 3 of those taxes usually wash out to be about 25 to 30% effectively, meaning if you have $1 million worth of gain, be prepared to pay $250,000 to $300,000 worth of taxes upon the sale of that investment. Section 1031 exchange is always called an interest-free loan from the government. And what that means is you're using the Internal Revenue Service's money that you owe them and basically leveraging it into your next investment. So you're getting a return on that investment, increased returns, increased return on your equity, less leverage out there, and basically the IOU is to the government. And we're going to give you a strategy that allows you to not pay that loan. Basically defer, and die, and have that loan discharged upon your death, meaning you are going to leave your heirs without a tax liability. Section 1031 exchange is all about basis. How do you determine your basis? So if you bought a property for $500,000, that's your cost basis. If you've taken $50,000 worth of depreciation, you would adjust your basis downwards by $50,000, meaning on that $500,000 asset, you would now have a $450,000 adjusted basis. If you've improved the property, put on a new roof, put in a bathtub, or put in a new kitchen, and that cost you $100,000 to the same property, your new adjusted basis would be $550,000. So if 10 years from now you sell that property for $1 million, you're going to be subject to $450,000 worth of capital gain, therefore subject to the 3 taxes we just described: federal, state, and depreciation recapture tax.